This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's a financial crisis nobody expected. I'm going to show you how the U.S. consumer is about to tip off a 1.5 trillion wave of delinquencies in a sector, in a part of the economy that all the experts say is resilient. But now you're about to see could be the tipping point to the next crisis. Let's over to Bloomberg, where he picked today's story up with a headline: as landlords face a 1.5 trillion commercial real estate maturity wall, and this is coming in a place, again, a sector that is believed to be resilient due to the cash flows generated by rents. But I'm going to show you how the U.S. consumer is going to make this a whole lot worse than it's going to be. The value of buildings has broadly dropped after higher interest rates boosted funding costs for property owners. Those lower valuations make it harder for landlords to borrow as much, forcing many property owners to raise equity capital to secure new debt or to extend their existing facilities. But one thing they're not mentioning is the fact that a lot of complexes have been built. There was a lot of cheap and easy money during the pandemic, and a lot of developers borrowed it and built massive numbers of complexes that are coming available. That's really pushing the price down because there aren't as many people to fill them, and that's the challenge here. It has a little bit less to do with the other factor of buildings dropping because of higher interest rates. No, it has to do with the fact that there isn't demand. But when we talk about the issue of rates in banking, we need to understand that lower interest rates aren't going to solve the problem here. Now, many people believe they do. You hear all the time in the news, you hear that all the surveys saying we just need a couple interest rate cuts and everything's going to be all right. And this is the same thing these developers and builders believe, but the evidence suggests it's not the case at all. In fact, it's going to cause financial conditions to get even tighter. Let's take a look at this chart here, because we have the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. And the way you read this is anytime this blue line is above the horizontal black line, that means on net banks are tightening standards. And what that means is just harder to get a loan. In fact, many people that go in to get a loan, whether they're consumers or businesses, they find themselves getting turned away. And this leads to less credit creation, which is a dangerous point in a debt-based economy, because that's how new money is created. But let's look at this against the federal funds rate, because the prevailing view, even by the Federal Reserve, that they want people to believe is if they cut interest rates, financial conditions will ease. And this is something these developers are really hoping will happen. But we can look back through history, and the data is very clear. When the Fed cuts rates in red, banks still on net tighten lending standards. You see it happen again around 1995. Look at the dot-com bubble. Here you see a complete collapse in the funds rate, and yet on net banks continue to tighten lending standards. During the global financial crisis, it got even worse as they accelerated the amount of tightening despite the aggressive cuts by the Fed. Even leading into the pandemic, you see a little bit of rate cuts led to tighter conditions. And in fact, what we see coming is not easier, but it's going to get tighter. And this is a really big issue here, because a lot of people don't understand the factors of what causes financial conditions to tighten. Now, let's take a look at this next chart before we get into the details there. As we look at the yield curve here shown in red, and this is a 10-year minus 2-year. And what you see here is when the red line is below that horizontal black line, it means 2-year yields are higher than 10-year. Now, one of the issues here, if you're a bank, you make money on the spread of interest rates. You borrow at the short end of the curve, which is represented by 2-year yields, and you lend it out to businesses and consumers at the long end of the curve, which would be represented by 10-year. So when it's inverted, well, it means banks don't make money on the interest rate spread. They have to make it elsewhere. But you would think that lower interest rates would really be good for the banks in terms of fact that would bring more people out to borrow. But the challenge here is just the opposite, because when interest rates go down, well, yes, the curve starts to normalize, as we can see looking back at the chart here. You see as the red line goes up, that's indicating that interest rates are falling. So why are banks still tightening lending standards? Well, it makes perfect sense, because even though the curve gets normalized and short-term rates fall below long-term rates, the amount of interest they're generating at perpetually lower interest rates to cover losses, well, that is getting very small. So if, for example, a building was to go into default, the banks need enough interest generated off all the other loans to offset it. It makes it harder for the banks to cover risk here, and that's why financial conditions tighten, because they need to make sure who they're lending to can pay it back. They get very uncertain as rates come down, and that's why you see the yield curve rising as rates are falling and financial conditions get tighter. You see that happening, and then once again, the prevailing view is rates come down, things get better. What we will likely see is this blue line head back higher. And apartment buildings, which make up about 40% of looming maturities, are at the center of the refinancing wave, according to brokers. Many U.S. owners of the assets known as multifamily bought their property using 3-year floating rate loans during the easy money era. And once again, we come back to poor financial decisions. People believe that rates would stay low, that the economy would grow, and there wouldn't be an issue to refi later, so they took out these very low short-term 3-year floating rate loans with the expectation that the rates wouldn't go up much. But now they did. And the problem is these loans are coming due, and as you can imagine, they don't have the money to pay, and that puts us right squarely into a crisis where $1.5 trillion in loans could hit delinquencies. In fact, interest rate increases since then have eaten up much of their rental income, making it a challenge to secure additional equity. And so here you have the case. Lots of apartment and multifamily complexes are now upside down. Value of the buildings coming down. The cash flow is not enough. And next thing you know, as all these loans come due, well, it means they can either raise rents, which they don't have the margin to do because of all the additional properties coming available, or they're facing delinquency, and that's the problem. But if you're looking to make money in the markets, look no further, because we have made a big update to our CTA Timer Pro. We've started working on this on our Momentum Timer Pro. But look at this, as we went into the weekend, CTA Timer Pro, you want to beat the machines, we show you how. When they get in deep short position and that changes, we flag that as a trade. We sit on 16 open trades. All of them are up. We closed out 2 of these on Friday at 3.94% cumulative return. But maybe you like to trade momentum, like the RSI, the MACD, and things like that. The problem is you find yourself getting in late, out early. We aggregate them together with a proprietary overlay. Going into the weekend, we have 5 open trades. All of them were up. Closed one out on Friday for 1.55% gain. But what is a difference maker? Many people said, does it work? Does your system work? Can you prove it? So we built a complete backtest engine to test it, and we modeled it, and now we can look at, this is on our CTA Timer Pro, coming to Momentum Timer Pro once we get it done, but we can model every instance and tell you what the probability of success is, and we even put it in the notes. Here you can see what this went out to subscribers last week. According to backtest models, the signal that was generated that day had a greater than 50% success rate as a daily trade over a 21-day period, or over a 60-day, 3-day period, which is 3 month. Buy it open. There's your target. There's your stop losses. We do it all for you, and we give you the confidence to make money. Nobody else is doing this. They don't backtest their stuff. They know it doesn't work, and yet people pay for it. But with ours, you get the daily reports. You get the tradable signals. You have my opinion on the ones to do. We give you stop loss levels. We track them for you. We even update once a week on Saturdays the stop loss levels, 100% duplicatable, 30-day free trial. Links in the description below, because while rising insurance costs and falling values have added to the pain, you can make money in the markets. We show you how. And this is leaving about $95 billion of the U.S. properties in distress or at risk of becoming so. And that is dangerous, because the Fed, even though they're planning to cut, what I wanted you to see is they're going to cause financial conditions to tighten. So while these property owners are championing lower interest rates, they don't realize they may not even qualify for them. That's a problem. And even if they do, well, I'm going to show you why the U.S. consumer is going to be the one that nudges all of that debt into delinquency and put us deep into a financial crisis. A large portion of the multifamily world is underwater at the moment, and a lot of equity is gone, but it's an asset class that's pretty resilient. That's the key word, resilient. Over time, it's underwritable. It just needs capital infusion. And why they say it's resilient is because of the cash flow. But what if the cash flow were to change? And that's the issue here, is that is coming, and that is going to be a big problem. And yes, these are underwater because a lot of the owners sucked out a lot of the equity. And what did they do? They went and built and bought more property, adding to the problem. It's going to get worse, as the looming debt maturities are also a potential headache for Wall Street, well, more so for investors, after many of the floating rate loans were bundled into the $80 billion commercial real estate collateralized loan obligation market, and here you go, and sold off as bonds to investors who are carrying the risk. Even so, trouble in the commercial real estate market isn't seen by investors as a systemic issue for banks because they've offloaded a lot of it. And that's the problem here, is investors are sitting on this debt. They don't realize it's toxic. They don't know it's headed into delinquency, and odds are a lot of it's going to default when I show you what's going on with U.S. consumers. And when the outlook for interest rate cuts becoming clear, there's optimism that large-scale distress can be avoided in the wider CRE market. And that's why I wanted to show you the data. I wanted to show you that financial conditions get tighter, not easier, when rates fall, because everyone believes in the power of the Fed. Just cut rates a little bit and everyone will be okay. The reality is it's going to get worse. And the number of lenders submitting quotes for debt refinancings has doubled on average this year. Just goes to show how desperate they are, with the funding gap right now between 200 and 400 billion, set to get to 1.5 trillion by the end of next year. And you can see when we look at the delinquency rates, this is the myth, that you cut rates and things get better. But let's look at loans secured by real estate at all commercial banks, is shown in blue. And you can see the delinquency rate rises as the Fed cuts rates. So again, everyone's hopeful. All we need is a Fed to cut and everything will be fine. But look what happened during the financial crisis. The Fed did cut rates and things spiraled out of control. We're seeing the same setup here. It's going to be a massive problem in commercial real estate, and nobody thought multifamily units were going to be a problem until they started to find out that a lot of these developers were very confident in the market. They took the equity on these low interest rate loans and bought and built new properties and put low interest rate loans on all of them. And now they're finding out they just don't have people to fill them anywhere close to what they need. And while some traditional lenders are focused on working out their problem loans, other banks, life insurers, and direct lenders who are sitting on all this toxic debt are willing to extend more credit, because what do you do when you face delinquency and default with someone you've lent money to? It's called extend and pretend and hope it all plays out. It's been a more constrained cycle this time around. Banks don't want to take over assets if they can put a new business plan in place and get an exit, which means they're going to extend the maturity on this debt and pray that it all works out. But if the financial crisis kicks in and gets deep, banks could be in big trouble. As a result, debt funds may find fewer opportunities to deploy capital than expected, and the cycle is healed. Again, did people believe this to the point of commercial mortgage-backed securities coming back? The agencies are coming back, and the banks have started to lend into commercial real estate. But as I showed you, when the Fed cuts rates, the banks are going to tighten financial conditions. They're not going to want to lend, particularly as we now turn to issues with the U.S. consumer that could be the tipping point that sends this $1.5 trillion deep into delinquency and default. Because what's coming by the end of the month is student loan leniency is ending soon. And here's what you need to know. Of course, we note that many people who are sitting on student loans, they are renters. And keep in mind, they're going to have to pay their student loans. And at some point, with the economy slowing and work opportunities diminishing, hours work going down, well, some point, something is going to break. Because a repayment grace period that rolled out by President Joe Biden is set to conclude at the end of September, smack in the middle of a contentious presidential election. The policy has been shielding borrowers from the worst repercussions of missed payments for the past year, as it will likely squeeze millions of wallets across the U.S., given more than 40 million Americans have federal student loan debt. So you can see the catalyst here. This is setting up to be a disaster, because all these apartment complexes and multifamily units that are desperately going to need the cash flow to go to the banks or insurers or whoever's sitting on this debt and say, look, we've got the cash flow. And what if the cash flow position changes because the people they're renting to suddenly have to make payments on their student loan debt. Watch out below, because the plan initially set repayments at 10% of borrower's income above a certain threshold. It was slated to be reduced to 5% in July. But check this, a district court in Kansas temporarily stopped the change, and the July appeals court ruled blocking it entirely. The Education Department has placed borrowers already enrolled in the program on administrative forbearance, meaning they don't have to pay their loans as the agency sorts out its next steps. The danger here is when they have to start making payments, something is going to give. You're going to watch the discretionary side of this economy outright collapse. In fact, we're seeing the early signs of that as consumers pull back on their spending. And all that's going to do is lead to plummeting confidence. As we now turn to U.S. Consumer Sentiment Survey that's by the University of Michigan, they're saying it rises for the first time in 5 months. You want to know why? Well, it's to do with the Fed cutting rates and everyone believing in the myth of it. But check this out. The final August sentiment index rose to 67.9 from 66.4 in July. That's a positive change. Consumers expect prices will climb at an annualized rate of 2.8% over the next year, down from the 2.9 expected last month, and the lowest now since 2020, despite the prior view that inflation was going to surge higher. They see costs rising 3% on average over the next 5 to 10 years, which is everything to do with gas prices. You see here right now, this is the inflation expectations in blue from the University of Michigan against U.S. regular all formations gas price. That's shown in red. As gas prices go down, well, that means inflation expectations go with it. But while cooling price pressures are helping to stabilize sentiment, consumers remain hamstrung by still elevated borrowing costs, less hiring, there's a key point, and higher cost of living. So you start to factor these student loan repayments coming in, and it's going to squeeze their budgets in a huge way. Many of them are not going to be able to afford their rent payments as they prioritize other things. That's going to put these property developers and managers in a big problem, because as they go to the banks to refi and say, look at our cash flow, they're going to watch their cash flow go down, and the banks aren't going to want to touch this at all. In fact, the university's confidence measure is well short of pre-pandemic levels. And as a result, buying plans for durable goods such as cars and appliances slipped to the lowest level since the end of 2022. And so think about this. When people spend less, well, that means demand's going down, and those businesses that have people on payrolls that are seeing their new orders drop, they're seeing their backlogs work through, they're not seeing their sales go the way they want as their inventories stay bloated. What are they going to be forced to do? That's right, cut hours and lay people off. You can see this thing spiraling right out of control. And while a separate report earlier Friday showed solid consumer spending at the start of the third quarter, discretionary income barely rose. We talked about that, and the savings rate dropped to a 2-year low. And as things get worse, of course, consumers are going to have to save. Maybe they'll stop paying on their rent. You can see this thing snowballing out of control. But look at this, buying conditions on homes plunge. You also see further drops in durable goods and vehicles, showing that consumers are going to cut spending. Demand's going to go away. U.S. economy squarely now headed into recession and a massive financial crisis. This is going to be just 1.5 trillion of the broader spectrum of what we're going to see in the commercial real estate as building prices have fallen, and we're going to see the small and mid-sized regional banks, which are holding a lot of those loans, come unglued. It's going to be quite the event, and that helps explain why consumers view their finances as currently stretched. The university's report shows sentiment at about personal finances now at the lowest level since October, and well below historical average. The index of news heard about the economy deteriorated over 20% this month. In particular, about 25% of consumers mentioned hearing negative news about unemployment, the highest reading since November of 2023. And what happens when consumers start to hear bad things about the job market and they go to work and they see things slowing down, they see their friends or family members or former coworkers not be able to get another job, they cut their spending. You can see why we're seeing and are going to expect a higher unemployment rate. As we look at consumer sentiment here, and yes, we did get a bit of a rebound, but if you look back, as the unemployment rate rises here, shown in red, well, that means reversals of sentiment, and they're going to come crumbling down. We could be seeing now the first wave lower sentiment, telling us that we are squarely headed to recession, because you look at this, as consumers change their buying conditions, and the labor market comes apart, you have a perfect track record of a recession each and every time. And a measure of expectations rose to 72.1 this month from 68.8 in July, as consumers hope that rate cuts will turn it around, but it's not going to happen. And while their outlook for their personal finances rose to a 3-month high, the current conditions fell to 61.3, the weakest since the end of 2022. And again, consumers hoping, just as businesses, just as these property developers, everybody's hoping that rate cuts will make a difference. And we're going to find out after September, as we've shown in the past, they're not going to make any difference at all. And now points to even more unexpected debt heading to delinquency, into default. And this is going to put a huge strain on the banks, insurers, and everyone else that's holding all this debt. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.